Trump's tariff wars could have profound implications on one of the world's most crucial resources, oil. China, a major buyer of U.S. oil, has already imposed a 10% tariff on imports. Meanwhile, Canada, the top oil supplier to the U.S., faces uncertainty as the U.S. considers reinstating a 10% tariff on Canadian crude imports. If you invest in oil futures, here is what you need to know about how tariffs could affect the price of oil. Despite being the world's top oil producer, the U.S. still relies heavily on imports, which brings us to Canada. As we can see from this chart, Canada has been the main source of oil imports to the U.S. since 2014. Pipelines like Keystone, Enbridge's Mainline, and the Trans Mountain System connect Canadian oil fields to the U.S. refineries, particularly in the Midwest and Gulf Coast, making Canadian crude the most accessible and cost-effective oil for the U.S. At the same time, Canada exports about 80 to 90% of its oil production to the U.S., so losing this key buyer would be a major blow to its industry. A tariff on Canadian oil would likely push U.S. gas prices higher while also driving up WTI and Brent crude prices due to the added tax on Canadian imports.